Today is Friday, November the 1st, and yesterday's market sell-off was almost 2%. Is this a precursor of the election that's coming next week? Hello, my name is Paul Carroll, the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. Thursday's tech stock sell-off wiped out all of October's gains. In fact, it's the worst sell-off in over 2 months. But it's hardly surprising to see a tech sell-off giving tech's nosebleed altitude valuations. But so much of these nosebleed valuations are a result of AI, and AI is still very much an unknown quantity, especially in terms of how do you monetize it. The thing to understand about markets, and we've talked about this before, is they're very much expectations machines, and valuations hold steady if the expectations are met. So even if it's a good outcome, if it's not as good as anticipated, it will have a negative impact on the market. The opposite's also true. If expectations are negative, even if it's less negative, not positive, that will have a good outcome in terms of markets. But markets in the short term are also static. They're very noisy. And we know that because already today, Friday, Amazon is up on great news. The market has recovered 1%, and it's not even lunchtime yet. The other thing we've talked about pretty regularly is the role of elections in markets. Elections and markets are almost completely non-correlated. There are 100 reasons for markets to move, but election outcomes tend to be fairly forecastable. Now, this one is a tight one, and there may be a short-term bounce or dip depending on how it comes out. But the long-term challenges facing the next administration, regardless of who it is uncontrollable spending that is almost impossible to cut in an atmosphere where the third rail of politics is to raise taxes. That's going to be a tough nut for anyone to carry. And that is what the bond market is reacting to. A rising interest rate environment often is symptomatic of an expectation of a greater demand for money. And as long as the government's running a 6% deficit and talking about even more spending and or tax cuts, then the markets are probably quite right to expect a greater demand for money in the future. And that is why, even despite short-term rate cuts by the Fed, we're seeing long-term rates climb slowly. That's hurting mortgages, making home ownership more expensive, and hurting the entire construction industry. Fortunately, the market is on the whole doing great. It's running on all 8 cylinders, and despite the slowly rising interest rates, there's a lot of good news. There's a lot of good reasons to be optimistic about the next decade for the economy. So given what I've just said, what do we do? Well, my prescription is if you've got a long-term plan, stick to it. That was the whole point of the long-term part. But be ready, be psychologically ready to take advantage of short-term jitters. Volatility actually is a gift to asset allocators, because in a volatile environment, investments either become overvalued or undervalued. In either direction, that's a rebalancing opportunity. So keep your cool when everyone else loses theirs. We wish you the best of investment success, and call me if you have any questions. Thank you.